I've been absolutely geeking out on the data this year and spent the entire year preparing the video I'm about to deliver today. Now, as you guys all know, property is my absolute obsession and passion, but data is even more so. Now, after talking to the great Phil Anderson recently, we could be in for one of the biggest asset booms in human history, which is why in today's video, I'm going to give you a really brief rundown on the long-term cycle. But most importantly, I'm going to talk about the 3 previous cycles and what happened to stocks, gold prices, and property leading into and into the last GFC. Effectively, if we look at the start of the current cycle, everybody knows the last GFC, which ended in about 2010 to 2011. Now, based on this longer term 18.6 year cycle, you generally get a period of about 7 to 8 years up, which is called the first half of the cycle. Then we hit a point where some markets in the world are starting to get a bit bubbly and confidence turns negative, and we go into what we call the mid-cycle slowdown. Now, the last mid-cycle was obviously COVID. The one before that was the dot-com boom and bust and 9/11. And the one before that was the recession we had to have. Now, what generally happens and what you've seen over the last couple of years is that confidence comes back into the market as they realize that the system isn't in as bad a position as it was in the last GFC. And the banks around the world, as well as the governments, just load the system with heaps of cash, which creates the second half of the real estate cycle. Now, this period of time, again, can last anywhere between sort of 5 to 7 years. And then we get to a point where there's mass speculation and get ourselves into, unfortunately, another GFC style event. Other names of these in the past is kind of like the Great Depression. Now, I've done heaps of other videos on my YouTube channel and podcast around the 18.6 year real estate cycle. If you want to see me go heaps deeper into the cycle and which of Australia's markets move at different points of the cycle so that you can take advantage of timing as an investor. But what I really wanted to explain is after catching up with Phil for lunch recently, he basically looked at these periods of up stages of the cycle across each of Australia's 8 capital cities over the last 3 real estate cycles or 60 years. Now, what he found is that in this 14 years of blue period up, the average Australian property market in a capital city will go up by at least 120%. Now, what he did is when he analysed the GFC period or the 4 years down over the period of the last 60 years or the last 3 cycles, including the last GFC, he found that the average Australian property market in the capital cities went down by between 8 and 12%, which is very different to America, where American property prices in the last couple of hundred years in these GFC style events can go down by an average of up to 35%. What I wanted to really talk about is, well, how did asset prices in the Australian property market, stock market, and gold markets, as well as the American market, perform running up into the last GFC, as well as the decline through the GFC period? And this is where it becomes super important and valuable to you as an investor in terms of what could potentially come next and how to take advantage of this coming asset boom. Now, if we look at the asset class first, which is my obvious favorite, and that is houses in Australia, in the 4 years leading into the last GFC, in Sydney, house prices went up 16%. Now, in Melbourne, over that 4 year period leading into the last GFC, we saw prices go up 14%. Now, during that same period of time, as we went into the GFC, house prices in the period between 2007 and 2009, so over a 3 year period, in Sydney went up 3%, which isn't even keeping up with inflation. And in Melbourne, they went up about 17% during that GFC period. So that's not bad, especially when the American market on average went down by between 15 and 37%, depending on the suburb and the state in the last GFC. Now, I've talked about this in previous cycles. Generally, Sydney, Melbourne, New York, London, Tokyo, the big markets around the world do extremely well in the first half of the cycle, but then they get so speculated on and so overpriced, hint, like Sydney and Melbourne are right now, that I believe they are shithouse investments in the second half of the cycle. I could get in trouble for that, but I personally wouldn't put my money there. And since I found out about this information over 6 years ago, they really haven't done too much when you look at them properly. Both Sydney and Melbourne historically don't do exceptionally well leading into at least the last GFC when you look at them properly. Now, if we look at the last GFC in the 4 years leading into the GFC for houses in Brisbane as well as Perth, houses in Brisbane went up 64% and houses in Perth went up 74% in that 4 years leading into the last GFC. Now, what's even more interesting is as we went into that GFC, prices in Brisbane over that 3-year period between 2007 and 9 went up a further 27%, and in Perth, they went up a further 10%. Now, what's happening here, if you understand how to read long-term data and short-term trends, is basically places in Sydney and Melbourne right now, if you looked at the 10-year growth rates, have gone up on average between 9 and about 15% per annum since the last GFC. But if we look at places in Brisbane and Perth, there are countless suburbs in both cities that have done between 1 and about 6% over the last 10 years, which gives them room as we move into the final 4 years or 3 years of a cycle to do extremely well. And that's what happened last time around. Now, if we take another look at history and go back a previous cycle, Sydney, Melbourne, Brisbane, and Perth all did quite well leading into the GFC before the last GFC. Now, this is where things start get interesting, and that's why I titled the video, obviously, are we coming into the largest asset boom in Australian history? Now, obviously, we've seen that property can do extremely well in the 4 years leading into a GFC, but I also wanted to look at the stock market, and I'll talk about gold in a moment. Now, in the 4 years leading into the last GFC, we saw the S&P go up by 59% in America, and we saw the ASX 200, which is the Australian stock market, over this period of time go up 99%. Now, unfortunately, stocks get absolutely smashed in a GFC. In the Great Depression, they went down in some instances by 60 to 90%. In the last GFC, some stocks went down 30%, others went down by as much as 60%. But in the US stock market, these were the gains on the way up, 59% and 99% in Australia in the 4 years leading into the last GFC. The American stock market got absolutely smashed in the first 3 years of the GFC, going down by 50% on average. And the Australian stock market in the last GFC went down an average of 45% between 2007 and the bottom of 2009. Now, this is also really, really, really important information. There's obviously different ways of investing in both property and stocks, and I'm certainly not an accountant or a financial advisor, but if you're going to invest in American stocks, for example, with the hope of them going up by 60% like they did in the last GFC, only to decline by 50% in the 3 years after that, and your intention is to hold longer term, then we're talking about, less than 1% per annum real growth, or it's going to be way below inflation. Obviously, if you can time the market, get out at the top and then buy the bottom, you can do extremely well. But it's just got me thinking a little bit about asset allocation, risk versus reward, and what I ultimately want to do. Now, one thing that nobody talks about is in the second half of the cycle, the two things that do extremely well. Now, we generally see property around the world do extremely well in the secondary cities in the second half of the cycle, and we generally see commodities do extremely well as well. Now, if you look at two of Australia's major industries, one is mining, one is property, and that's why the Australian Stock Exchange has done fuck all basically since the last GFC until now, because it's been waiting for the second half of the cycle for the companies that profit during these times to explode and then for the market to price it in. The last one that I wanted to look at was obviously gold, which has always been called a hedge against inflation and a place to safely park money in GFC style events and the Great Depression. Now, in that 4 years between 2003 and 2007 leading into the GFC, gold prices went up 77%. And then as we moved into the GFC and the entire world panicked, gold actually went up a further 76% over that 3 years between 2007 and 2009. Now, what's even crazier is if we look at a longer term period of data between 2003 all the way through to 2010, which was sort of the end of the last GFC or the beginning of the recovery, gold prices went up by over 500%. So to round out today's video, there's a whole bunch of different takeaways and ideas. And effectively, I've got two different strategies personally to take advantage of the next 4 years as well as the opportunity down. Now, if I was a high risk investor, I would continue personally to buy property in Brisbane and Perth, and I would start to look at some gold as we move into this period of the cycle. Then once we got to the bottom of this particular market, I'd be looking for properties in Sydney, Melbourne, as well as stocks. And that's what I've learned from looking at the last 60 years or 3 cycles, that if you're a very aggressive investor, Brisbane, Perth, and gold look extremely good through this entire cycle. And then obviously as we get to the bottom, and Sydney and Melbourne haven't really done anything in real terms for almost 9 years. In fact, at the bottom of the last GFC in 2011, when I personally started buying Sydney, if you looked at the long-term data, Sydney had done less than 1% per annum for the 9 years leading into it. Hint, hint. So Sydney, Melbourne look good, and stocks look good as well. Now, I'm not a high-risk investor, and most people aren't. So for me personally, if you said, Ben, what are you going to be doing between now and then? I'm going to be buying property in Brisbane because it's what I know. The Olympic Games are coming up. And when I sat down with Phil Anderson and said, what could Brisbane do between now and the top? He said somewhere between 50 and 70% based on 60 years worth of data. I also said, well, hey, we've got a GFC. What could happen? And when we looked back at the last 3 cycles, Brisbane on average had only gone down by 12%, which he said weren't even the entry and exiting costs of exiting a market. So there was no point in freak out selling like a lot of people will do in the next GFC. And then I said, we've got this Olympic Games coming. What will happen there? And he said, because of the tourism, the jobs, the population and infrastructure growth around the Olympics, plus the speculation, Brisbane might get through the next GFC in much better shape than other cities. Now, I wish I could say that I was going to buy a little bit of gold between now and then, because 500% returns over 7 years throughout the last run-up and then GFC look phenomenal. But I'm a fair pussy and I don't know heaps about it. So maybe that's something that you guys could put in the comments below if you know more about gold than I do. And then as we get to the next GFC, but I'll definitely pick up some stocks at a bargain at this point if I've got some cash and I'm not too much of a pussy because everyone else is scared. And then for me personally, I'm not too much of a Melbourne fan, but I am a huge Sydney fan. Nothing against Melbourne at all, except I don't know that market. I grew up in Sydney and I bought a lot of property in Sydney for myself and clients previously. So I'll go from Brisbane back to Sydney when Sydney looks good, with the hope that Sydney does extremely well in the first half of the next cycle, and go through the motions again and again. But it's pretty exciting, guys, what's coming. I think there's 2 ways of looking at the future. One is to learn from the past, to prepare for it and hope for the best, but expect the worst. The second is just to bury your head in the sand, be extremely scared like so many people have been since the last GFC or since the mid-cycle slowdown in COVID or since interest rates started to go up, and not really being aware of what's going on, not looking at history close enough like I have in this video and I've shared with you to make better decisions. Ultimately, at the end of the day, I hope you've really, really enjoyed this video. If you haven't already done so, please give this video a thumbs up. Please subscribe to the channel. And for those of you out there that are looking to buy an investment property in the next 12 months and really set yourselves up for what could be coming based on Phil Anderson, Fred Harrison, and Simon Priestley's work, then I'd love to offer you a one-on-one strategy session where we can talk about where you are right now, where you'd like to be in 15 to 20 years from now, knowing that we're going to go through multiple cycles and up and down markets over that period of time. You can book that session by going to www.pumpedonproperty.com and clicking that free strategy session button. And then you can take this information, some more information on the market, and some different ideas that we have so that you can safely invest through this period with a grain of salt and go and smash it on your own, like so many people have. Alternatively, you might decide to become one of the extremely small number of clients that we take on each month, that we educate on this, as well as so many other concepts based on history, so that you can not just buy great properties, but get a mentor, a coach, an incredible education, and really set yourselves up safely to take advantage of what's to come, and then to protect your downside in the future as we go through different markets as well. But either way, I really, really do wish you all the best. I'm so grateful that I found this information from Phil, that it came into my life and that I can share it with you. And I really do hope that we go through a period similar to previous ones where asset prices go up. So many of you can take advantage of that. And then obviously the scary downside for most people, you're now aware of it well before the average person is. In fact, I'd be surprised if this video even gets 5,000 views. So don't think just because you know about it that everybody else does, or they're as interested in this stuff as you are. And please take advantage of it, but in a safe way and without hurting anybody else. I wish you all the best, guys. Catch you down the line.
Woo! That's a wrap.
That's a wrap.
Getting cool, bro. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that. So nice, eh? Oh.